I'm going to share with you DIY investors with what could be the easiest investing video you've ever seen in Canada. Easy because I'm going to show you how to get your entire investment plan in just ETFs. Now, this video is geared towards beginner DIY investors looking for a set it and forget it approach where you don't have to do any research for the rest of your life. In today's video, I'm going to cover the basics of an ETF versus bond versus mutual funds. I'm also going to cover the 3 golden rules of investing in ETFs. Most importantly, I'm going to cover example ETFs and let you know who's it for and who's it not for. Let's start with the basics. We have mutual funds. These are funds that you probably have heard and been pushed on. When you go to a bank, one of the first things they do is assign you a financial advisor and they start pushing mutual funds, which is literally a basket of companies where you pay high management fees. Now, benefits of a mutual fund is that there's convenience. You get to buy a basket of companies and they are actively managed by humans. So you get diversification and you get to buy it all in one shot. But the issue is there is high management fees. We're talking 1 to 2%. So for every $100,000 you invest in, that's $1,000 of fees that's going to a human being. So why are management fees so expensive? It's because you have different components you're paying. You're paying for taxes. You're paying for human managing the account. You're paying for service fees. You're paying for expenses. And that means it can range from 1 to 2%. So at a bare minimum, for every $100,000 you invested, that's $1,000 that's going to a human being. What is an electronic traded fund? They're literally just a basket of companies that represent an area, a focused area. So it could be real estate, it could be healthcare, it could be tech stocks. It could be any sector that you're thinking of. The advantages of an electronic traded fund is that it has very low management fees compared to, say, an actively traded fund, which is like a mutual fund. They're highly liquid, meaning you can buy them and sell them like this with a click of a button. They're super popular because they have very low management fees. We're talking about less than 1%. A very good example is, say, an index fund, a Vanguard fund like VFE. You can see the management fees are ultra low because there is literally no human managing this account. It's automatically rebalanced by a computer. Just in case you don't know what an index fund, an index represents a stock market. So it could be, for example, the S&P 500, which is 500 of the biggest companies in North America. Or you could have a Canadian stock market, where it's called TSX 60, and you have 60 of the biggest companies in Canada. The goal of this index fund is to mimic a certain market. The next term that gets thrown around in investing is a bond. The bond is literally a loan agreement to a government or a company. And in return, you get paid interest. For example, if they want to build a super highway across Canada, that is going to be via bonds to pay for that superhighway across Canada, issued by the government. Before I jump into the 3 ETFs that I would hold for the long term and not even have to worry about doing any research, let's talk about the 3 golden rules of investing in ETFs. The first rule is how much should you invest in the stock market? The formula is 100 minus your age. If you are 30 years old, 100 minus 30 means 70% of your entire investment portfolio should be invested in equities, aka the stock market. And the balance of that, which is 30%, should be invested in something that's not related to the stock market. A very popular way is investing in bonds, or my favorite is real estate. Rule number 2, what is your end goal? Is it a big wad of cash 20, 30 years down the road where it helps pay for retirement? Or is it to build a snowball, a dividend snowball, where you get cash flow that you can live off retirement and also pass it on to your kids so you never have to sell your stocks? You could be collecting income and pass that income towards your kids. Or 3, it's a mixture of both, where you want a big wad of cash in retirement, but you also want some income like very soon, because maybe you have a much more ambitious plan, which is financial independence, and you want to pivot in your career or travel around the world. But my point is, please figure out your end goal because it will determine the mix of ETFs you're going to invest in. And don't worry, I'm going to share some returns, long-term returns you can expect with very minimal risks in the ETFs I'm going to share with you later on in the video. Number 3, these investments are not guaranteed. So they're not like guaranteed investment certificates. For example, when I said bond, those are literally loans that you can make to corporations, to the government, so that they could do things with that money. But those are not guaranteed. And that's really important because I don't want you to think that the rule being 100 minus your age is what you invest in the stock market or the equities, which is correct. But the balance of it, aka that 30%, please don't think you could just lock into guaranteed investment certificates and think it will be keeping up with inflation. Do you remember COVID, when inflation was running high, when our cost of groceries, our fuel costs, our housing costs were just running rampant? Well, if you invested all your money, say like that 30% chunk, into a guaranteed investment certificate, say you bought a term of 2% in 2019, and all of a sudden you fast forward to COVID and the inflation's running way higher than 2%, you're essentially losing money. Just think about it. Have you ever bought bubble tea in 2019, which is around $5, and right now it is like closer to $10, if not more? That's because of inflation. If you're going to invest in guaranteed investment certificates instead of bonds, you could be losing money every single year due to inflation. Let's talk about the 3 ETFs that I would hold for the long term if I wanted to invest very simply. The first ETF is ticker symbol VFV if you have Canadian funds, or VOO if you have US funds, as quoted by one of the greatest investors of the world, Warren Buffett. He says, for most people, they should invest in the S&P 500. This ETF is literally the foundation. And if you are confident with the North American economy being the 500 biggest companies in North America, and you're going to do pleasantly well with just clicking a button and buying one ETF called VFE in Canadian funds, or VOO, which is in US funds. Now, there is a lot of talk about how much you can get in return for investing in the S&P 500, which is on average 8 to 10% over the very, very, very long run. But let's talk about something that most people don't talk about, which is what are your chances of losing your money? As you can see, if you invested into the S&P 500 and the longer you hold on to your money, the bigger chances of winning. For example, if you held it for 1 month, there's a chance, 38% chance, that you will lose your money. But if you fast forward and jump to 5 years, you only have 11% chance. And then all of a sudden fast forward and you go to 15 years, you only have 0.2% chance of losing your money. But you must hold on to that money more than 5 years. Not 1 year, 5 years. And better if you do 10 years, 20 years, 30 years, then your chances of winning are going to increase substantially. The next ETF that I really, really like is for those who are looking for moolah to come in every single month. This ETF is ticker symbol XIU. XIU literally is just composes of a bunch of dinosaur companies in Canada that are really mature companies that pay you monthly income. We're talking about the banks, the telecommunication companies, the energy companies. So we're talking about TD Bank, Royal Bank, Bell Mobility, Enbridge, TELUS, all pretty boring. And why I like this ETF especially is because as Canadians, and it's been a rule of mine, I only invest in what I know. And if you invest in a bunch of companies that you pay bills anyway, like to your Enbridge bill, to your phone bill, to your bank, you know that those are not going to go anywhere because we keep having to pay them and they're making a ton of money. So why not profit from them, collecting dividend checks every single month? Dividends being money that you collect just for simply holding onto these companies. The next ETF is going to be a very ultra conservative ETF because we need it in every portfolio or something equivalent to it. And the one that I really like is BND, which is a Vanguard ETF. By the way, this video is not sponsored by Vanguard. I just happen to like their funds. Getting back to this ETF, this represents a bunch of loans that you make to companies and to the government, and they get to use that money, invest into infrastructure. The reason why you would invest in this ETF is because not only for the rule of 100, where You don't want 100% exposure to the stock market because there's going to be times when the stock market completely sucks and you don't want your entire portfolio just tanking. So you invest into bonds, which is simply unrelated to the stock market. Now let's talk about what type of returns you can expect if you had an ETF portfolio of VFV, which is 500 of the biggest companies in North America, versus bonds or XIU, which is the dividend ETF, or you want to invest in real estate. And I'll give you a bonus. So as you can see, I've got 3 portfolios and it shows you the different type of returns you can expect, as well, most importantly, the drawdown you can expect by having this type of portfolio. We're going to assume someone is 30 years old. So 100 minus 30 means they should have 70% in equities and 30% could be in bonds. It could be something in real estate or whatever you're comfortable with, like a dividend ETF. As you can see, the different percentages are quite close to each other, but the most important thing is the drawdown. The drawdown is least in the bond portfolio, where you have 30% of your portfolio in bond. I wouldn't stress about what type of returns that you're going to get in each of these portfolios. They're all double digit. I think you should ask yourself, where are you in your life? Are you retiring in the next 5 years? And could you suffer a drawdown, which is a drop in the stock market that will drastically cut your income or your return? Or do you have 40 plus years before you retire? Then that changes the whole thing. What I'm trying to get at is having and stressing about the percentage of stocks versus bonds or stocks versus real estate. It just comes down to a very personal choice. By the way, if you're a Canadian investor or a US investor looking to join an investing community to make investing a lot less lonely journey, I would highly recommend downloading the app called Blossom, which is a free app to help you learn to invest and to talk to people like me. I am on Blossom. I share my latest trades. You can ask me questions. I read every comment. And best part, you can get paid to actually learn to invest in the app and see what is the most popular stocks that people are buying. As you can see, the number 1 is VFV on the Blossom app, and there's more than 150,000 users. A lot of them are Canadian. If you want to learn how to invest and get more than $1 million tax-free, check out this video up here. If you're looking to build $1,000 per month forever, then check out this video down here. Anyways, I hope to see you in the next video. Bye.